What if the digital gold everyone thought would change money forever wasn't gold at all? What if Bitcoin, the invention meant to free people from banks, ended up repeating the very mistakes it was built to destroy? This is the story of the Bitcoin crash. How an idea born out of rebellion became one of the most explosive financial experiments in history. Why did it rise so fast? What invisible forces sent it crashing down? And most importantly, what does that tell us about the future of money itself? By the end of this video, you'll see how Bitcoin historia isn't just about technology or markets, it is about human behavior, trust, and the oldest emotions in finance, fear and greed. Let's begin. The year is 2008. Banks are failing. Housing markets are imploding. The global financial system, the one we thought was unbreakable, is on its knees. People are losing their homes, their savings, their faith in money itself. And in that darkness, a message appears on a cryptography mailing list. A 9-page paper titled Bitcoin, a peer-to-peer electronic cash system. Its author, someone or some group calling themselves Satoshi Nakamoto. No one knows who they are. No one knows where they're from. But the idea inside that paper will soon set off one of the greatest financial revolutions and collapses of the modern age. Bitcoin was built on one promise: money without banks, trust without governments, power without permission. And for a moment, it looked unstoppable. But what started as a rebellion would soon become a rush, a gold rush. And every gold rush ends the same way. In 2009, Bitcoin was launched as open-source software. At first, it had no value. Literally zero. Early users traded it as an experimenta, digital toy for cryptography enthusiasts. Then came the legend of the pizza. On May 22, 2010, a man named Laszlo Hanyas paid 10,000 bitcoins for 2 pizzas. Today, those bitcoins would be worth hundreds of millions of dollars. That transaction marked a turning point. Bitcoin had a price, and once something has a price, people start to speculate. Slowly, a small online community began mining, trading, and hoarding the new currency. They believed it was scarce. Only 21 million bitcoins could ever exist. And scarcity creates value. By 2011, Bitcoin climbed from just a few cents to over $30. It was a revolutionary idea colliding with a perfect storm of public anger and technological optimism. People wanted freedom from central banks. Hackers and libertarians saw it as rebellion made digital. Investors saw it as the next gold rush. Media outlets called it the future of money. Tech blogs predicted it would end banks forever. And when Bitcoin hit mainstream exchanges, the crowd arrived. From 2013 to 2017, Bitcoin's price exploded, reaching nearly $19,000 in December 2017. That's a rise of more than 1,900,000% from its earliest price. But behind the scenes, trouble was brewing. The same factors driving Bitcoin up, hype, greed, and belief, were also loading the gun for its crash. Because when everyone believes something can only go up, it never does. The turning point came at the end of 2017. Bitcoin had become a global frenzy. People were mortgaging homes, selling cars, even quitting jobs to invest. And then, the selling began. From December 2017 to December 2018, Bitcoin lost over 84% of its value. Billions of dollars evaporated in months. Why did it crash so violently? The causes were many, but each one tells a part of the story. Speculative overload, too many people buying just because it was rising. Regulatory backlash, governments, especially in China, banned or restricted crypto trading. Exchange hacks, massive breaches like Bitfinex destroyed trust. Media panic once optimism turned to fear. The narrative collapsed. By mid-2018, what was on say, the future of money was now Kaiyed, the greatest bubble since the dot-com crash. They even gave it a name, Crypto Winter, after the crash. The fallout spread fast. Investors lost fortunes. Exchanges went bankrupt. Scams, multiplied fake coins, pump and dump schemes, Ponzi projects. Governments stepped in with tighter regulations. Bitcoin's image as a tool of financial freedom began to crack. Instead, it was now seen as volatile, unstable, and risky. Many who had shouted to the moon quietly disappeared. Others doubled down, claiming it was just a temporary setback. But something deeper had changed. Trust. Bitcoin's promise had been built on the idea of trust in code, not people. Yet, when people lost faith, the code alone couldn't save it. After the crash, developers, entrepreneurs, and regulators tried to rebuild. Some focused on technology fixes, faster transactions, more efficient networks, privacy upgrades. Others went for financial legitimacy. Bitcoin ETFs, futures markets, institutional custody, and then came the wave of altcoins: Ethereum, Ripple, Litecoin, Dogecoin niche, promising to fix Bitcoin's flaws. But most of these solutions had the same problem. Speculation outweighed utility. People weren't using these coins to buy things. They were buying them to sell later at a higher price. In short, Bitcoin's ecosystem was expanding, but not maturing. And while the H-fix delayed the inevitable, none addressed the root cause, the belief that price equals progress. If this story sounds familiar, it should, because it happened again. In 2020, in 2021, Bitcoin roared back. Stimulus money flooded markets. Tech enthusiasm returned. Celebrities endorsed crypto. Elon Musk tweeted about it. Bitcoin hit an all-time high of $68,000 in November 2021. Then, as interest rates rose and liquidity dried up, the market collapsed again. By November 2022, Bitcoin was down nearly 77% from its peak. Once more, the same pattern. Hype. Boom. Overconfidence. Regulation. Collapse. And this time, the casualties were even bigger. Major crypto firms like FTX imploded. Investors lost billions overnight. Public trust in the entire crypto industry was shattered. History didn't just repeat it. So why does this keep happening? Because Bitcoin isn't just a financial experiment. It's a psychological mirror. It exposes how humans behave when they believe they've found a shortcut to wealth. Bitcoin's crashes aren't only about technology or economics. They're about hope, greed, fear, and faith. When people believe in something deeply even, irrationality creates bubbles. And bubbles, by definition, must burst. Just as the tulip mania of the 1600s ended in ruin, just as the South Sea bubble bankrupted Britain, just as the dot-com bubble wiped out a generation of investors, Bitcoin's crash is another chapter in the same ancient story. The tools change. The timeline changes. But the psychology, it's timeless. So where are we now? Is Bitcoin just dormant? Despite the crashes, Bitcoin hasn't vanished. It's still traded worldwide, still mined, still championed by believers. In some countries, it's even become a legal currency. In others, it's banned entirely. But whether you love or hate it, Bitcoin changed the world. It forced banks to modernize. It sparked a race in digital currencies, and it gave birth to an entire decentralized ecosystem, from NFTs to DeFi. Yet, the same warning echoes. Every revolution that begins with freedom eventually faces control, and every promise of easy wealth ends with a reckoning. Bitcoin might rise again, but if it does, it will carry the memory of every crash before it. Here are 3 key takeaways from Bitcoin's wild ride. First, nothing rises forever. Every market, no matter how revolutionary, obeys gravity. When prices rise faster than reason, reality eventually catches up. Second, technology doesn't erase human emotion. Bitcoin's code may be perfect, but humans aren't. Greed, fear, and herd behavior still rule every market, digital or not. And third, belief is powerful, but dangerous. The same faith that builds innovation can also build bubbles. Never confuse belief with truth. 10 years from now, when we look back, how will we remember Bitcoin? As the foundation of a new financial era, or as the cautionary tale of how freedom and greed collided? Maybe it's both. Maybe the real value of Bitcoin isn't in its price, but in what it taught us about ourselves. Because the next crash may not be in crypto. It may be somewhere we least expect. If you found this story thought-provoking, make sure to subscribe to Shadows of History and turn on the bell, because next time we'll dive into another financial mystery that shaped the world.